So I want you to imagine designing an incredibly complex physical product, right?
Okay.
And you're paying a completely different company to handle the incredibly difficult task of actually manufacturing it.
Right, which is usually very expensive.
Exactly. But you still walk away with a 75% profit margin. And you're doing this at a scale of like over $80 billion a quarter.
Yeah, which is, I mean, by every traditional rule of physical hardware manufacturing, that scale and that profitability, they should completely contradict each other.
They really should. Welcome to today's deep dive, everyone. We are looking at a really incredibly revealing script from Nvidia's Q1 FY27 investor presentation.
It's a fascinating document.
It really is. And our mission today is basically to decode the financial DNA of the current AI era. We've got this massive stack of data from the company supplying the foundational infrastructure for the whole global AI build-out.
The picks and shovels, basically.
Exactly, the picks and shovels. And we're going to break down exactly how their internal machinery is generating these unprecedented numbers. Because, okay, let's unpack this. Financial reports can be dense, I know, but this one tells a dramatic story of hypergrowth.
Yeah, and actually, really quickly, just to set a baseline for you as we look at this data, the fiscal calendar here is marked as FY27, but this presentation was actually released in May of 2026.
Right, that can be confusing for people.
Yeah. Companies often run on fiscal years that just don't match the standard January to December calendar. It helps them better align with their specific sales cycles. So when we analyze Q1 FY27 today, we are looking at their actual finalized financial performance for the quarter that ended in early 2026.
Got it. Okay, so let's start with the top line. Because the sheer scale of the revenue growth here, it's hard to fully grasp without context.
It really is.
Like in the first quarter of the previous year, so FY26, they reported $44.1 billion in revenue, which is already huge. But fast forward exactly 12 months to Q1 FY27, and that number hit $81.6 billion.
It's staggering. I mean, you're looking at an 85% year-over-year increase for a company that was already operating in the tens of billions.
Right. So what is the mechanism driving that explosion? Because that's what we really need to focus on today.
Well, it's definitely not just a general uptick in, basic cloud computing demand. It is directly tied to the widespread deployment of their Blackwell GPU architecture.
And Blackwell isn't just a single chip, right?
No, not at all. It functions as an entire interconnected platform that data centers are just adopting wholesale.
Okay, because the presentation also outlines some very specific new catalysts for this computing demand. It mentions agentic AI and reinforcement learning.
Right.
So how exactly do those two things tax a system differently than what we've seen before? Because everyone's used a chatbot by now.
Yeah, and it basically comes down to the computing loop. So with standard generative AI, a user prompts a chatbot, the system burns compute power to generate a single response. And
Just stops.
Exactly, it stops. But agentic AI, or autonomous AI, it doesn't stop. It acts as a digital agent on your behalf.
Oh, wow.
Yeah, so if you ask it to, say, organize a project, it might search the web, synthesize that data, open your calendar, draft emails, schedule meetings.
All autonomously.
All autonomously. And that requires a continuous, multi-step loop of processing.
So it's essentially running in the background constantly, just eating up server capacity.
Exactly. And then reinforcement learning, that amplifies it even further. This is AI that learns through trial and error.
Right.
It runs millions, sometimes billions of simulated environments to find the optimal path to a solution, whether that's for robotic movement or complex logistical routing. The sheer volume of continuous calculations required for those millions of trials puts this exponential load on the hardware, way more than a simple text query.
That's incredible. And I see they're already preparing for the hardware demands beyond that, noting their next major platform launch, Vera Rubin, is slated for the third quarter in the second half of the year.
Yeah, they are not slowing down.
But the source notes also point out that their infrastructure leads in MLPerf and InferenceX benchmarks, specifically for the lowest token cost and highest token throughput.
Right, the benchmark.
Now, I know a token in AI terms is basically a chunk of data, like a piece of a word or a fraction of an image. So high throughput means they process these chunks incredibly fast. But the lowest token cost metric, That feels like the real weapon here, doesn't it?
Oh, absolutely. It is the ultimate metric for cloud providers. I mean, when a hyperscaler like AWS or Google Cloud is processing trillions of tokens a day for their enterprise customers,
Yeah.
saving a fraction of a single cent per token, that translates to billions of dollars in operational savings. Processing faster is great, but processing it cheaper per unit is what actually wins the data center contracts.
Which, okay, that brings up a healthy dose of skepticism I think we really need to apply here on behalf of the listener.
Let's hear it.
If they are selling these incredibly efficient but highly expensive platforms, are we just watching like 3 or 4 massive tech giants buy up the entire supply?
Ah, I see what you're getting at.
Right, because if $81.6 billion is propped up by just a few hyperscalers in an arms race, that feels like a very fragile foundation for this kind of growth. What happens if they stop buying?
It's a fair question. But if you look at the specific customer breakdown within their data center revenue, you actually see a much more resilient foundation. The hyperscalers, those massive cloud providers are thinking of, they did account for a huge portion. They grew 115% year over year.
Wow.
Yeah, jumping from $17.6 billion to $37.9 billion.
Okay, so the tech titans are absolutely spending a fortune.
They are, but the crucial data point here is the AI cloud industrial and enterprise sector, or ACIE.
Okay, what is that exactly?
This category includes specialized AI clouds and everyday corporate enterprises. Think automotive companies, healthcare networks, logistics firms, companies who are integrating AI directly into their own infrastructure.
Okay, so normal businesses, basically.
Exactly. And that ACIE sector grew 74%, rising from $21.5 billion to $37.4 billion.
Wait, hold on. Those numbers are almost identical. The hyperscalers spent $37.9 billion, and the everyday enterprise sector spent $37.4 billion.
Yes. That parity is actually the most important takeaway from the revenue breakdown. It proves that the demand for this hardware is no longer confined to just a sandbox of 4 tech giants. The spending is broad-based, and it's actively spreading across traditional industries that are realizing they need localized, highly capable AI infrastructure.
Which naturally leads us to the operational reality of fulfilling that massive broad-based demand. Because usually when a hardware company scales their production to meet a near doubling in revenue...
Things get messy.
Exactly. The friction of scaling eats into their margins. You're expediting shipping, paying overtime, sourcing scarce raw materials. But here, their gross margins actually expanded.
They didn't just expand. They reached levels that are incredibly rare for physical products. Their GAAP gross margin, which follows the strict, generally accepted accounting principles, leapt from 60.5% up to 74.9% year over year.
Let me put that 75% margin into perspective for you listening. Software companies, they regularly hit 75 or 80% margins because once the code is written, copy-pasting a digital file to a new customer costs, well, virtually nothing.
Right.
But producing a bleeding-edge silicon chip requires specialized materials, hyper-clean environments, and incredibly complex manufacturing. So to achieve a 75% margin on physical hardware it's just staggering.
It really is. And the mechanics behind that margin jump are illuminating. Because it isn't just a matter of Nvidia unilaterally deciding to hike prices because they have a monopoly on the best tech.
Oh.
A massive part of this year-over-year margin improvement actually comes from the shedding of a past liability.
Okay, looking at the notes, I see something here about a major inventory provision from the prior year.
Yes. The presentation details a $4.5 billion charge related to H2O excess inventory.
What exactly was the H2O, and how does it relate to these crazy margins?
So the H2O was a specific, scaled-down chip that Nvidia engineered to comply with very strict U.S. export restrictions regarding what kind of computing power could be sold into China.
Right, the export controls.
Right. But as market conditions and the regulatory environments shifted, the anticipated demand for that specific nerfed chip, it just didn't materialize as expected. So they were left holding a massive amount of inventory that they couldn't sell at the projected full value.
Okay, I get it. It's essentially like a major retailer overbuying like winter coats.
Yes, exactly.
And then realizing in February that they have millions left in the warehouse.
Yeah.
And they're forced by accounting rules to mark down the value of that inventory and take the projected loss up front.
That is the perfect way to look at it. Last year, they had to swallow that $4.5 billion write-down, which legally looked like a massive expense on their spreadsheet. And that artificially depressed their gross margins down to 60.5%.
I see.
But now that the H2O inventory burden has been absorbed and cleared out, they're selling their new current generation platforms at full value. So what we're seeing at 74.9% is the unobstructed underlying profitability of their core hardware engine, just running entirely clean.
Wow. Okay, so the raw manufacturing of the chips is wildly profitable. But gross margin only tells us what it costs to make the physical product. Running a multinational corporation generating over $80 billion a quarter requires, paying thousands of top-tier engineers,
Definitely.
funding massive R&D for that upcoming Vera Rubin platform, managing global marketing. So how much are they spending just to keep the corporate machine running during this hypergrowth?
We find that in their operating expenses, or OPEX, their GAAP operating expenses grew from $5.0 billion in the previous year to $7.6 billion this quarter.
Okay, so that is roughly a 50% increase in operating costs,
Exactly.
which is a massive jump in spending. I mean, adding $2.6 billion to your baseline operational costs in a single year means hiring a lot of people and building out a lot of internal infrastructure.
It is a significant increase, but this introduces one of the most powerful financial concepts in business: operating leverage.
Operating leverage, okay.
Yeah, operating leverage in a company like this functions a lot like building a modern toll road.
Okay, I like a good analogy. Go on.
Well, paving that road, funding the R&D, writing the software stack, building the corporate infrastructure that costs billions of dollars up front. But once the road is operational, whether 10 cars drive on it or 10,000 cars drive on it, your maintenance costs stay relatively flat.
Oh, I see. And right now, Nvidia is watching 10,000 cars pull up to the toll booth while their maintenance costs are only slightly increasing because their operating expenses went up 50%, but their revenue went up 85%.
Exactly. When revenue scales that much faster than fixed operating costs, every new dollar of revenue costs you significantly less to generate. And the result is an explosive acceleration in bottom line profit, which is clearly reflected in their earnings per share, or EPS.
Right.
Because of that operating leverage, their GAAP EPS jumped from 76 cents a share a year ago to an incredible $2.39 a share this quarter.
Wait, hold on. Looking at the reconciliation tables here, there is a massive anomaly.
You spotted it.
Yeah, every corporate earnings call I've ever listened to features management desperately pointing investors toward their non-GAAP numbers. Because they use non-GAAP to strip out messy, one-time expenses or restructuring costs, basically to present this idealized, filtered version of the company's profitability. Usually a company's strict, by-the-books GAAP profit is much lower.
Usually, yes.
But here, NVIDIA's strictly regulated GAAP EPS is $2.39, and their filtered non-GAAP EPS is actually significantly lower, at $1.87. How is it mechanically possible that the strict accounting makes them look so much richer?
It's a fascinating inversion of the standard corporate playbook, really. And it comes down to two major factors and how they reconcile those numbers. The first factor is a monumental financial windfall that occurred outside of their core chip-selling business.
Outside of the chips.
Yeah. Their total GAAP net income hit $58.3 billion. But that number was inflated by a staggering $15.882 billion in non-operating income.
Wait, almost $16 billion just dropped onto the balance sheet from something completely unrelated to their operational leverage or GPU sales. What was it?
The documentation points to equity securities and dividend income.
Oh, wow.
Yeah. NVIDIA has made strategic investments in other companies and technologies outside of their core operations, and those investments generated a massive return this quarter. Strict GAAP accounting requires them to include that $15.8 billion windfall in their official net income.
Right.
However, they rightly exclude it from their non-GAAP adjusted earnings because counting investment windfalls would paint an inaccurate picture of their day-to-day hardware business.
That makes total sense. They made a killing in the market. But they don't want investors confusing that with their recurring chip revenue. So what is the second reason for the anomaly?
The second reason is a major accounting shift that anyone tracking this company needs to understand. Starting in this specific quarter, Q1 FY27, NVIDIA is no longer excluding stock-based compensation from its non-GAAP metrics.
By stock-based compensation, you mean the stock options and grants they hand out to their engineers and executives as part of their salary packages.
Correct. Historically, the vast majority of tech companies exclude stock-based compensation from their adjusted non-GAAP earnings.
Right, because they argue that since they're handing out shares, not physical cash, it's a non-cash expense that shouldn't count against their operational profitability.
Exactly. It's a very common tactic used to make tech profits look artificially higher.
But NVIDIA has decided to stop playing that game. They are choosing to leave that expense in their adjusted numbers.
They are.
That is a highly conservative approach to financial reporting. I mean, they are essentially saying, even when we include the massive amount of stock we pay our employees, and even when we strip out the $16 billion investment windfall, our core business is still generating phenomenal profit.
Yep. It is a massive signal of confidence in the underlying strength of their operations. And that operational strength translates directly to the most important metric for long-term corporate survival: actual physical cash.
Cash is king.
Always. Let's look at their free cash flow. This is the cash generated after accounting for all the money needed to maintain or expand the business. Last year, their Q1 free cash flow was $26.1 billion.
Okay.
This quarter, it surged to $48.5 billion. Furthermore, their net cash provided strictly by operating activities hit $50.3 billion.
Okay, generating $50 billion in pure operating cash in 90 days is mind-bending. But looking at the cash flow statement, there is another number here that stands out because of how small it is.
Yeah, their capital expenditures, the money they spent investing in physical property and equipment for their own operations, was only $1.7 billion. How is the company manufacturing the most complex hardware on Earth, spending less than $2 billion on physical infrastructure?
It comes down to their fundamental business model. Nvidia is largely a fabless semiconductor company. Right, meaning they spend their billions on R&D to design the architecture of the chips, but they outsource the actual physical fabrication to specialized manufacturing giants, most notably TSMC in Taiwan.
Okay, so while a company like Intel might have to burn $20 billion in capital expenditures just to build a single new manufacturing plant, Nvidia avoids that entirely.
Exactly.
They let TSMC build the multi-billion-dollar factories, while Nvidia just pays them to run the production lines. That is the ultimate cheat code for generating massive free cash flow.
That fabless model is the exact reason they're sitting on a mountain of cash with relatively low internal infrastructure costs. And the presentation outlines exactly what they're doing with that mountain of cash. They are aggressively redirecting it back to their investors.
Makes sense.
In Q1 alone, they returned roughly $20 billion to shareholders.
And that is just the baseline, honestly. The future commitments they've outlined here are historic. Because if they are confident enough to authorize these next moves, their internal modeling for the coming years must be bulletproof. The sources show they announced a staggering $80 billion in new share repurchases.
And that $80 billion is layered on top of roughly $39 billion they still had remaining in a previous authorization.
Oh, wow.
Yeah, that means the board has authorized the company to buy back nearly $120 billion of its own stock.
Which is huge because buying back stock reduces the total number of shares available, which inherently makes every remaining share more valuable.
Precisely. And on top of that, they raised their cash dividend by 25 times. It moved from a nominal penny a share to 25 cents a share.
A 25x dividend increase and a $120 billion buyback authorization. That really begs the question, does their internal guidance for the upcoming quarter actually justify that level of aggressive shareholder reward? What does the crystal ball look like for Q2 FY27?
Well, their forward-looking guidance projects Q2 revenue at $91.0 billion, plus or minus 2%. They also project that they'll maintain that phenomenal 75% gross margin.
Guiding for $91 billion in a single quarter, it just feels like we're running out of adjectives to describe the scale here.
There is a vital piece of context attached to that $91 billion projection, though, that you have to read the fine print to catch. They explicitly note that this guidance excludes China data center computing revenue.
Wait, they completely modeled out one of the largest technology markets in the world.
They did. Due to the complex geopolitical dynamics and the unpredictable nature of export regulations, like we discussed earlier with that H2O chip, Nvidia has chosen to model their baseline without relying on the Chinese data center market.
Which means that $91 billion might actually be a highly conservative floor. I mean, if the regulatory environment stabilizes, or if they secure pathways to sell compliant technology into that market, that $91 billion suddenly has massive upside potential.
Exactly. It's a calculated conservative projection that still sets records.
Well, synthesizing everything we've unpacked today, the sheer economic force of this presentation is remarkable. And for you listening, this goes far beyond just tracking a single company's stock price. Whether you're actively managing a portfolio, working adjacent to the tech sector, or simply trying to understand the AI revolution, these numbers are the ultimate anchor to reality.
They really are.
They prove that the shift to artificial intelligence isn't just a conceptual hype cycle fueled by venture capital. It is a tangible economic machine operating at the highest levels of global finance. It's driven by very real demand for platforms like Blackwell, hyper-efficient operating leverage, and a business model uniquely positioned to capture unprecedented cash flow.
The foundational layer of AI is undeniably structurally profitable for Nvidia. But as we wrap up, I do want to leave you with a broader thought regarding the entire ecosystem.
Okay,
Because this deep dive proves beyond a shadow of a doubt that selling the picks and shovels of the AI gold rush is the greatest business in the world right now.
without a doubt.
But if Nvidia is routinely pulling in $80 to $90 billion a quarter, primarily from hyperscalers and everyday enterprises buying this infrastructure, it raises the most critical question for the next phase of the tech economy. At what point do Nvidia's customers, the massive cloud providers and corporate networks, need to start showing equivalent financial returns on their own AI investments?
That's the multi-billion-dollar question.
Right. How many quarters can they justify spending tens of billions of dollars on hardware before their own shareholders demand proof that this infrastructure is generating an equivalent massive surge in end-user software revenue?
The ROI reckoning. Until those everyday companies and hyperscalers can definitively prove they've actually struck gold with their AI deployments, keep a very close eye on the companies selling the shovels. Thank you for joining us on this deep dive into the numbers shaping the future. Keep questioning the hype and keep following the data.